Dzień dobry, witam Państwa.
Good afternoon, ladies and gentlemen. Welcome to the conference for the LPP results after the third quarter of 2018. We've had a very good quarter. We're very happy about our results, sales and profit as well. But now let's move on to some details. So the sales of the group grew by 16% after 9 months of this year, with the help of the growth of 10.2% growth of floor space. But we also have a very good sales in the stores. LFLs grew by 9.2%, and we continue a growing trend and good sales that grew by over 100% in our online channel. Geographically, we continue expansion. The plans for 2 years included opening in 3 new markets, and in the third quarter we achieved those goals: Slovenia and Israel in August, and in October we opened in Kazakhstan. That was the fourth quarter. Let's take a look at our table with the number of stores. The biggest number of new stores was in Sinsay, 43 stores more, but it's now not just about the stores but also about the floor space, and we open bigger and bigger stores in both concepts. In Reserved, in our flagship brand, and in other brands the stores are bigger and bigger. For example, an average floor space in a Reserved is 1200 square meters, and because we have a lot of old Reserved stores, well, this is because of that, because the new Reserved stores that are opened right now, the floor space is over 2,100 meters, 2,500 meters. Now about the opening windows. Before we've been opening stores regularly throughout the whole year, and now we are saying that we are just opening in 2 quarters, second and the fourth quarter. Why those quarters? It's very simple actually. If you take a look at the cycle of turnout of the sales, then we have sell-off periods, for instance, July and August. So by opening the store, we observe how we collect the inventory throughout several months. Then we don't really want to open the store whenever during the sell-off period, because then the sales starts. So that's why we want to do it in the second and the fourth quarter, where we can actually start with regular prices of our products. And now a bit about sales. LFLs, well, growth 3.6%. Well, we could say that this is not so good as compared to the 3 other quarters, but this 3% is the growth starting with a very strong base that grew by 15% in the third quarter of 2017. Well, what does that mean? That means that we cannot expect a very strong growth in the coming quarters, but that also means that the second half of the 2017 and the first half of 2018 were a very good period for us, when we strengthened our brands, especially Reserved, and we improved our results. And we can see a dynamic growth in e-commerce, online sales. This is over 100% growth year on year. And now let's take a look at the brands, revenues by brands. So the best brands are the main brands, Reserved, for instance. Crop and Mojito did not as well. Sometimes it happens that some brands have worse collections, worse periods, and then they improve. For instance, House. A year ago, House was not selling that good, and now, this year, this is doing very well, 2-digit growths. Now, geographically, sales by geography, by regions. Poland is still growing, but these are 1-digit growths, and most of the growth comes from abroad. during the third quarter, for the first time, LPP has a bigger floor space abroad than in Poland. Well, that is followed by the growth of sales quicker than in Poland. And you can see that the Europe, excluding Poland, 23% growth, and CIS countries, 22% year-on-year. This is the growth. And the total sales, group sales, grew by over 20% in the third quarter. But let's take a look at the table where we feature revenues by square meter. Well, the total sales per square meters is growing, still growing, because that includes the stores and online sales, but the retail part, so the stores, actual stores, you can see some of the drops revenues per square meters year-on-year because, well, the rents are higher and the sale per square meter is lower and the cost of the square meter is dropping down, so the economics of the store remains very good. And the margin is growing. And in this quarter that is being discussed, we are talking about 51%, so growth by 2 percentage points as compared to the previous period. And period after period, we are improving our margins. That means that we sell more at full price and less of our inventories are sold during the sales period. And you can see the FX situation. Well, this is comparable year-on-year, the price, so the margins will not be growing that fast as before. And now the cost. As usually on the left, this is the graph with own stores distributed into rental costs, HR costs, and other costs. Generally, the cost has dropped by 3% year-on-year in all three areas. So the rental, HR cost, and other costs, this is where we have drops, lower costs, rental costs, bigger floor space than the less cost, and HR costs. We are improving our management. We outsource some measures, some activities to external companies, and this is also impacted by the ban on sales on Sundays, and also other costs, energy, protection, security services. And they also dropped those costs. On the other hand, let's take a look at SG&A costs. Foreign logistics cost is growing along with the development of the company. And this is the growth where you can see 5% growth year-on-year. It seems that in the coming periods, this dynamics should be dropping down a little bit. So we should be managing our costs better. And we can see the sales, looking at the LFLs, not so spectacular there. So the costs should be at stop as well. So summarizing, revenues are growing by over 12%, SG&A costs 16%, but we are helped by the EBIT and margin. So the EBIT margin, EBIT is 25.3% and net profit is 7.6%. After 9 months, we have much better gross profit margin year-on-year. So the operational profit is doing really fine. Now let's move on to the inventories. As you can see, everything's under control. And during the third quarter of this year, we had 3% less inventories as compared to the previous year. But per square meter, it was even 12% less than last year. On the other hand, we have a very important element, working capital. 2 years ago, we told you that our goal is to decrease the working capital invested in the brands, so equalizing trade liabilities and inventory level. And I can actually tell you that this year we were able to achieve this goal. So our trade liabilities are even higher than the inventory level. So we received back the whole cash that was before frozen in our working capital, having more money out of the working capital and improved situation. We are actually having a better situation, 525 million of the cash net after the 9 months. And we need the money because we are investing a lot. You can see that during the last two quarters, so the second and the third quarter of 2018, well, you can see that our outlays are growing. The green part is more or less stable. These are the investment in stores. Well, this gray part is growing here. These are our infrastructural investment. Headquarters of the company, so extension, as well as our warehouses, construction in Brześć Kujawski, and further development of Pruszcz warehouse. So summarizing the 9 months, we are happy about the sales in the traditional stores. We are happy about the online sales. Margins are better. The cost of the stores are under control. Inventories are under control. And LPP has a very good position, strong position, having a lot of cash net in our balance sheet. And now key corporate events. So we've opened a new market, Israel. We've mentioned that during the previous meeting. In September, we opened a store in another country, Slovenia. We have a new reserved campaign, advertising campaign. And in September, we have opened the 20th reserved store in Germany. So now looking through those events, well, new campaign. Autumn-winter reserved campaign. I Can Boogie, that was the title that referred to the 1970s and to two well-known celebrities, Joanna Kulik, a very well-known Polish actress, and French influencer and model, Jean Damas. So that was the advertisement campaign in 3 installments that was featured in September this year. After a very successful change in the reserved collection, we support this brand not just by good advertisement, but also by improving the collection. Well, that happened last year in the female clothes. And we improved the kids' collection, and now the time came to improve the male collection as well. So we expect that the new, better, improved male collections will be featured in the new campaign, Spring-Summer collection. And a new thing that is happening in Reserved, we introduce more premium products, better quality, better fabrics, and we can see that, well, they are quite popular. There is high demand for them in Poland and abroad as well. So we will be introducing more products of that as well. This is often happening in Europe, but also in Romania, Poland, or Ukraine. Expansion, a bit about expansion. Another market that was added to our markets. Slovenia was the 5th country in the Balkans. Next year, we will also open Bosnia and Herzegovina. We are very happy with the growth of sales in Romania. Therefore, we decided to open another warehouse on this market, but this will be dedicated to online sales. And I've been asked how much will this cost us, how much capex will be spent on that. Well, ladies and gentlemen, we will not be spending any capex because it will be outsourced, because technological park will construct it and will run it, but we will be paying per each shipment completion and returns. So out of this warehouse located in Romania that will be opened in 2019, we'll be sending e-commerce online packages to all countries in Europe. Another interesting market is Germany. Recently, we've opened the 20th reserved store in Frankfurt at the main street, commercial street. So that was the 20th store, but we have 19 stores there because recently we've closed a store in Ludwigsburg that happened in third quarter of 2018. Well, what can I say? This is a difficult market, more complex, much more complex than we've planned. We will have to wait for the success, but our plans do not include removal of our stores from this market. We continue our plans in that include investment in marketing, advertising, winning, attracting new customers, and developing, improving the offer that is dedicated for this market. And another market, the 23rd market launched for LPP, Kazakhstan, that opened in the third quarter of 2018. That was it was open in Almaty. And well, we will be also opening new brands in Almaty as well. And next year, all brands will be opened. All brand stores will be opened in the capital city in Astana. And now, 2018 and 2019 outlook. You know that the sales is really growing. That is supported by the growth of floor space, and total growth of floor space will be the growth will be 9% this year. In Poland, this will be 3%, and good dynamics, double-digit dynamics are outside of Poland. So Europe and CIS. Of course, the highest growth is for Sinsay, which is the youngest brand in our group, but there is also a strong 10% growth in Reserved. The capex will be 320 million per square stores, and total capex will be 560 million. So we plan the total e-commerce in 2018 should exceed 9%. This will be group sales, and our plans are quite ambitious. This will be the growth by 20% within 3 years, and we will achieve that by opening new online stores in new countries, so Ukraine and the EU countries. So our goals that we've announced at the beginning of the year, well, we stand by them. So 2-digit growth of sales. I need to remind you that we are talking about 6% after 9 months. The margin should be between 54, 56%. We stand by this goal, and our costs are under control, and net cash is in our portfolio. And now about 2019, because we get the questions like the similar structure. Poland has a small growth, 2%, but this will definitely change, because we'll be closing down smaller stores but opening bigger stores, floor space stores. The growth by regions: Europe 23%, and really nice growth in CIS 15%. So our capex next year will be about 700 million zloty, a huge impact of the infrastructural investment, and we will open on 2 new markets, Bosnia and Herzegovina and Finland, in October next year. And that's all from me. Ladies and gentlemen, thank you so much for your attention, and now let's have some questions. If we could ask the questions to the microphone, my colleague will reach you with the mic in a moment, and I'll try to answer the questions. Michał Kuzwiński, JP Morgan. Continuing the plans for the next year, do you know anything about guidance, similar guidance that you gave for this year? How about margin with this dollar rate? What about the growth of income and the cost? How does that work? So you would like to hear more guidance about the next year margin, cost, and income. I think it's a bit too early for that. I can tell you some general information without any specific numbers. I believe that during the next meeting, when we meet at the beginning of the next year, I will tell you some more concrete situation, more concrete information and objectives. Well, the e-commerce online will be growing, but this will be two-digit growth, not three-digit like last year. And well, we will be trying to achieve two-digit growth of the total sales. It's hard to say what will happen to the margin. As a company, we will do everything that we can to have the margins growing by better collections, by better management of inventories, by better location of the inventories. We treat each store individually. But the question is, what will happen with the dollar exchange rate? If it's over 3.8, around 4 zloty per US dollar, well, this will be a negative impact on the margins. So we do everything that we can to make the situation okay. But if the dollar exchange rate will continue to be at this level as today, everything will be fine. But after this high growth of e-commerce cost and logistical cost, well, we will be working on the costs as well. The cost per square meter shouldn't grow more than this year. Well, the total cost per square meter. Of course, the general question is about the general economic situation, but we will try to continue the trends that you can see this year, also in 2019. And about margin, I have one question about margin. Can you see whether the margin can be maintained with the current US dollar exchange rate? Given that it will change in spring, summer. Well, seeing our good work on the product, how our margin in e-commerce is growing after our investment in e-commerce, even with some trading promotions, I believe that we are able to fit into the same situation between 54–56%. But if the situation with the US dollar changes significantly, well, the situation may change. Please go ahead. We have one question at the front. I have a question about LFLs. We can see 9.2% growth. This is for the group and the whole world. How does that relate to Poland? Because we have the ban on Sunday trade. And, well, generally, this is a negative influence for the trading companies. 3% LFLs per the past 3 months and 9% per 9 months. Poland is below the 9%. Poland had 6% growth in LFLs after 9%. And as far as the first 6 months didn't show any negative influence on of the ban on Sunday trading, because the customers were coming back to us. We had a very good collection, and this is what we were saying, that there is no impact right now. But now, seeing what is happening in the fourth quarter, when the basis is comparable year on year, we can see the impact. The impact is unfortunately negative, and the customers are moving towards other days, Friday and Saturday. They also do online shopping. Well, we can see other countries 9% and Poland 6%. Very good growth in Russia, also in Romania and Hungary in the south of Europe. Well, Poland right now is not developing that fast, but that's very good that our e-commerce is doing fine. I can't believe that there are no more questions today. No more questions. Michał, we can always count on Michał. He always has some questions. I have one question about the competition. So, what's your opinion here? How about the dynamics, competition dynamics? Did it change or not? How about the prices? Some competitors are coming down to your levels. Now taking into account the dollar exchange rate, because in the previous cycle when the dollar price was growing, then Initex decided to have more a competitive price policy, which you struggled with a little bit. So this scenario, is it possible in the future? This is a very difficult question because I don't know about the decisions our competitors is making. Well, but on the market, we can't see very strong events such as the ones that took place in 2015. We don't see any price war or anything else like that. We can see a status quo on the market. Everybody would like to improve their situation on the market, but we don't see any reason for increasing the prices. But the level of prices continues to be similar to the past. We don't see any strong movements from our competitors, so the situation is good for our company. Go ahead. We have one more question, I believe. If not, then thank you so much, ladies and gentlemen, for your attention. Oh, I'm sorry. We've got one more question from our online viewers. Two questions. Two online questions. A yearly cost of RFID cost estimated at 60 million zloty will be included in the results of the next year, and how soon the company expects to have positive results that will cover at least the cost of the project. The project RFID that is launched will be launched in spring this year, spring-summer collection, under reserved. Well, all commodities will come with RFID technology. The cost of 60 million zloty. Next year, not all of the cost will be included. We will be talking about 40 or 50 million zloty out of the amount. But how about the effects? Well, we believe that we will see the effects quite soon, quite quickly, for two reasons. So first of all, the workload will decrease in our traditional stores because the technology means that the commodity that comes to the store is already tagged, and before those tags were being put on the clothes by the employees of the stores. So this work will be already done, so the working hours will be decreased. On the other hand, our customers will be served quicker at the cashier desks. Well, we've tested this technology, and we are able to decrease the time of tagging of one piece of clothes from 5 to 6 seconds to 1 second. So the lines at the cashier desks will be shorter, and the customers will be happier because they will be served quicker. So we believe this will have a positive economical impact on the situation. Well, will we be able to cover the whole cost throughout the year? Most of it, yes. Of course, we have one more element, so higher sales that we are hoping for. And, well, so we estimate that most of the cost will be covered by the income. And taking into account the pressure for the salaries and the growing cost connected with the RFID cost, what about cost per square meter next year? As I said, below this year's, below 5% per square meter. This is the general estimation. As of today, there is one more question. How about the unfavorable October weather, and what's the influence? Will there be an influence on the sales in the fourth quarter? Well, it has already influenced the sales in the fourth quarter because October was really warm, so the sales weren't that good. The same goes for the first half of November, but let's see. Last Saturday, when the sales speeded up, accelerated, so the second half and of November and good December will help us to present good result during the next meeting, next conference. Thank you so much for your attention, and let's see each other next time.